A wonderful afternoon, everyone. Thank you for joining us today for Ask Me Anything Advisor Edition at Sarwa. Maybe want to give it a few minutes to let everyone in through the door. I do see a number of people have already joined us. Appreciate you joining us today. I know probably you've had a quite busy day and you're either making your way home from work or you've just got in. I appreciate you taking the time and making the effort to have a chat with us. Maybe we can just start with, I mean, look, guys, we're end of June, and typically, around this time of the year is when a lot of people take holidays. Any travel plans in mind? Oh, I meant you guys, Akshay and Faisal. Okay, anybody traveling on this end? Or anybody taking some time off?
Yeah, so I figured you were addressing us. I was like, am I gonna let Faisal speak first? Am I gonna speak first? So I'll take it. So I actually did a lot of traveling. I just got back yesterday from the US. So I'm gonna be here for all of July and then doing a little bit of traveling again in Europe in August. So here for the next about 6 weeks. So looking forward to the summer heat. But that's about it. How about yourself, Faisal?
I've been in the thick of the heat. Nothing planned yet. Was thinking of Europe sometime in July, but still up for planning. With everything that's been happening, I've been second guessing my plans.
Yeah, we'll touch on that, especially today.
Yeah.
Definitely the elephant in the room. I think that's something that people want to talk about. On my end, I'm going to be taking a few weeks. Going to go to Canada. My mom is retiring after 35 years of working for the same nursing home, and she's quite excited to kind of take a little bit of time for herself and tend to her garden. And we're going to throw a really nice retirement party for her. So we're all excited and we're all working together, my siblings and I, in different parts of the world, and we're all traveling back to host a really lovely retirement party.
Nice. Congrats.
Thank
Yeah,
you.
that's awesome.
Looks like we've got a few people through the door now. I think this is a good time to start. And for anyone that does join in, we'll recap them as much as we can. So what are we doing today? Today is AMA, Ask Me Anything Advisor Edition. And the whole idea is to add as much value as possible by answering questions that you might have. Burning questions that you may have been too shy or too nervous to ask, and now you can do it in the safety of this environment here. Whether you want to put your name and ask the questions or whether you want to anonymize it, it's all the same to us, really, at the end of the day. Our goal is really to just help and support you for you to achieve your financial goals. Each and every one of us have been in the financial services industry for quite some time, and one of the challenges that we do see is that many institutions do not do a great job of making clients a part of the conversation. More often than not, they're just told what to do, but they're never told why. We make great efforts here to include you in this conversation, to help you become as knowledgeable as possible, to empower you, because we know that will make you a better investor, and we think it's going to be a great working relationship. With that said, we do want to start with kind of giving you a quick overview of what's happened year to date. We're at the half year mark right now. Why not just have a quick recap of what we've seen, the highs, the lows, the weird in between, and maybe also touch on what's been happening within the region itself. Shall we, guys? Oh, apologize. We didn't even introduce ourselves. I know we're just talking on around. My name is Eamon Gebri, VP of Advisory here at Sarwa.
My name is Akshay Iyer. I'm one of the wealth advisors here at Sarwa.
Faisal Abdul also an advisor here at Sarwa.
Amazing. And on that note, third time now, let's do it.
Let's do it.
Amazing. So on screen, you're going to see a snapshot of what the US markets have gone through for this year. You're going to see notable indices here, such as the S&P 500, the Dow Jones Industrial Average, and you're also going to see the NASDAQ Composite. And each indices essentially has its own characteristics and I would say behavior as well. And you're going to notice some similarities at April, and we're going to touch on what happened in April. But essentially, we're going to see that the markets in general are up for the year, although not spectacularly, but they are up. So when you look at the S&P 500 as of last night, and we did have to kind of put a cutoff date, otherwise we're constantly going to be adjusting it second by second as the markets do change quite often. But as of last night, we're looking at about 3.6% appreciation in the S&P 500, the Dow Jones just under 1.3%, and the Nasdaq just above 3% year to date. What's happened so far year to date? And I would say to capture this succinctly, There's been a lot, and they all kind of rhyme with something called SMARIF, really at the end of the day. So tariffs have been the topic of conversation for most of the year. Starts off with the announcement of Liberation Day by the US, which essentially triggered a very sharp sell-off in April, as you would have seen, where the S&P and the Nasdaq and the Dow Jones were severely impacted, where there was severe, I would say, downwards pressure on the markets. A lot of confidence was lost, and I would say it caught the market by surprise. Although there was, discussions about potential tariffs, I don't think anybody really understood the level, or I would say the scope of tariffs that were going to be introduced on the world. So that did definitely spook the market. By spooking the market, I mean the VIX index itself spiked as markets feared the global trade disruption itself. Eventually, they were paused, and what that did was give relief to the markets themselves, and we actually saw a huge rebound to the point that the last time we've seen anything like this was back in 2008. So it was a significant, I would say, rebound in April itself, which was, started returning confidence to investors in the market altogether. And then there was rollbacks of some of the tariff policies as well too, where more specific to UK and China. Also, by the way, companies who were reporting their earnings for Q1. Surprisingly, 78% of them beat the analyst expectations for the quarter itself. So they had very strong earnings per share numbers for the quarter itself. So most of the losses that we saw leading into, May were essentially erased by mid-May. CPI numbers were also quite steady. They had eased down to the 2.3%, and the Fed hinted that, you know what, it might be a time to start considering reducing interest rates, but not so quickly, looking at maybe towards the second half of the year. But however, getting closer to the timeline that we're in today, where all of a sudden a conflict within our region erupted, and we're talking about Israel, Iran, and a number of surrounding countries within the space here, in which the conflict escalated. And that escalation also has led to fears of the Strait of Hormuz being blocked, which could have a direct impact on oil, but we'll touch on that in a bit. Now, obviously, if anybody who's been paying attention, there has been a ceasefire announced, and that obviously has given a little bit of relief to the market, which we saw last night. And I think it's a evolving situation, but overall, the S&P 500, Dow Jones Industrial, and the Nasdaq Composite are positive year to date, in spite of the very challenging year they've had. On that note, I'll hand it over to you, Akshay, to maybe tell us what it looks like over the pond.
Amazing, Eamon. Thank you so much. So yeah, obviously you just touched upon what's been happening in the US markets. And I think for a lot of our investors, that usually tends to be the key metric, right? What has the S&P 500 been doing? What's my investment doing compared to the S&P 500? And a lot of times people tend to overlook what's happening in the global developed markets. And this has been an incredible year for global developed markets, right? We were looking, Eamon, on your previous page, right? S&P 500 around 3% year to date. Everything was in the positive, which is great, by the way, for the halfway point of the year. But just diving a little bit deeper into the global markets, and I think this comes to a shock for a lot of investors, a lot of economists, a lot of analysts, and how these global developed markets have performed around the world so far this year, and what's been driving those moves. So we've got four indexes over here, right? We've got the FTSE 100, which represents the UK market, the top 100 UK companies, the DAX, which is the German market, the Nikkei 225, which is Japan's market, and the Hang Seng Index, which is Hong Kong's. Now, looking at the FTSE 100, year to date, the FTSE is up 6.26%. Right? The UK market saw a really solid rebound this year. A lot of that came down to global investors looking for value. I think at the time of which, the US market had a pretty rocky start with everything that was happening with the trade wars and the tariffs. A lot of global investors started to funnel their cash and their investments towards some of these developed markets, which historically have a more stable profile compared to your emerging markets and also at times US markets. And I think with everything going on with the trade tensions, that volatility that we saw in the US, people started to rotate into these markets, they started to look a little bit cheaper. And the UK definitely benefited from that shift. So year to date, the FTSE 100 is up 6.26%. I think that's almost double what the S&P 500 is up, which is, I would say a pretty big surprise for a lot of people. Now, going over to Germany, right, and the DAX. The DAX is up 18.11% per year. And that, the German market has had a very strong run this year. For a lot of people, what's actually been driving that run? People have been saying the industrial sector, right? The industrial sector in Germany bounced back. Exports actually picked up. There's been a huge demand from Asia that actually stayed healthy and continued to do so. And then also, we're going to touch upon this a bit further, but with currency, there was some currency tailwinds earlier in the year, and that actually made Germany as one of the standout performers globally. So 18.11%, which is really significant, especially year to date. We're looking at 6 months down the line, and that's what the developed market of Germany is looking like. I think that's, usually you see performance figures like that with more emerging market countries, but really solid to see. Now, sorry, Faisal, if we can go back. Yeah, perfect. So if we go look at the Nikkei, so that's Japan's index, and a little bit more flat, right? So it's down 0.93%. On the other hand, it's one of the few markets in the global developed markets that struggled. A stronger yen made exports a bit more expensive, and there were concerns around, weaker global demand. I think especially with all the supply chains feeling the pressure from the trade disputes that we saw in April, and that actually dragged the index down. So we saw a little bit of struggle from the Japanese markets. But just over to Hong Kong, and a huge difference, right? The Hang Seng Index is up 24.72% year to date, right? It had a huge market recovery. And I think this was driven mostly by these Chinese tech stocks that have made a big comeback, right? A lot more optimism around policy support with China. I think historically there's always been a lot of conflict in terms of what's happening in Shanghai compared to what's happening with Hong Kong, and especially with a lot of policy sort of disputes. This has been a lot more cooperative in so far this year, and I think a lot of that is to do with what's been led by U.S. tariffs. So that actually helped to turn sentiment around. The Hong Kong market had a really tough 2024. One of the big reasons why we're seeing such a standout year to date is because it's taken a bounce back from such a low point. So overall, global developed markets are looking solid. As I said, right, historically, you tend to see the US market dominate, the sort of growth, but at the moment, global developed markets are doing so. So interesting to see, it's only half year. We're at the half year mark, so we're going to see what happens, obviously, in the next 6 months. But for now, that's what's happening with global developed markets. I'm going to pass it over to you to tell us a bit more about what's been happening with emerging markets.
Thank you, Akshay. And it's interesting. Both of you mentioned how US is king, and then I would say developed markets comes next, and then emerging markets, right? It's always overlooked or underappreciated, I would say, but it has shown really steady growth and resilience this year. So here we have the two indices, China's Shanghai Composite Index, SSE, currently up around 6% year to date. And China's market has shown modest, as I said, but stable performance this year, mainly due to targeted stimulus and fiscal policy within China. Much of the decline and the volatility that China has seen in its market was a result, as Eamon and Akshay mentioned, the trade tensions and the global volatility, which weakened its exports and its industrial output. But recovery soon followed, as you can see in the graph. There's kind of an uptake after that whole fiasco, as the government really doubled down on infrastructure-led growth and a deflation-fighting policy. So the investor sentiment in China is still relatively cautious and is still weighing in the trade tensions, as well as the shaky real estate sector within China. And then next to or under China, we have India's BSE Sensex, which is or has performed around 5.4% year to date. And India has remained resilient throughout this global instability, and the strength mainly was driven by domestic demand and positive earnings. And Q1 saw a lot of volatility, like we saw on the other graphs. But here it was mainly due to the rupee weakening against the dollar and market corrections from a stellar 2024. So 2024 saw amazing positive returns, and markets started to correct. Profit taking was a factor as well for this correction this year. And of course, the trade tensions impacted the Indian market as well. But as I said, this was short-lived. Soon after, we saw foreign portfolio inflows into India, and also the Reserve Bank of India cut rates to support growth and kind of posture the market for a more pro-growth stance. Focusing a little bit still within emerging markets, but closer to home, looking at Dubai's DFM and Saudi's Tadawul. Interesting parallels, I would say here. They almost look like mirror images of one another. One is up around 8% year to date, and the other is also negatively inverse of that. So Dubai's DFM index, as I said, is year to date up around 8%. And the equity market in Dubai this year has outperformed its regional peers. I mean, out of all emerging markets, I believe Chile maybe outperformed UAE, but out of our lineup, it has outperformed emerging markets. And Q1 delivered record trading activity. Significant portion of this activity was due to institutional participation. In fact, 70% of the trading activity on DFM was led by institutional investors. And its performance was also largely driven by the strength in real estate, which we're going to touch on in a little bit. Banking sector and investor confidence in Dubai was also positioning the market for growth. Going to Saudi, Saudi's Tadawul hasn't fared as well. And mainly that's due to the oil volatility and being more sensitive or susceptible to the geopolitical situations around us, which ultimately leads to investor risk aversion. Even though Saudi has seen healthy non-oil sector growth, the sentiment has still been negative, and mainly due to the sensitivity to oil fluctuations, as well as the trade impact and the geopolitical situation. And unlike UAE or Dubai in particular, Saudi, again, is more sensitive to these factors, and it did not have a kind of a strong real estate market or a banking sector, and there wasn't an inflow of global investors into the Saudi market, nothing compared to what Dubai has seen, which has caused this growth. Now, moving on from equities and more onto digital assets or cryptocurrencies. And it's interesting to note, and it's important to note that previously and historically, cryptocurrencies have had a negative correlation to equities. But just in recent years, it started to have more of a positive correlation and started to be more reactive to the macroeconomic noise around us. Starting off with Bitcoin, currently, give or take a few basis points, it's up 14%. And it's had a strong year. Bitcoin, all in all, has been doing really well this year. It reached an all-time high of around $112,000 around May, which was mainly driven by institutional adoption, ETF inflows, and the US's recognition of Bitcoin as part of its strategic reserve, which added also a layer of, I would say, legitimacy to the cryptocurrency. And also what's interesting about this period for crypto is, unlike other all-time highs or other peaks that it's seen in 2018 and 2021, and I think we all kind of notice this, there's not much of a frenzy, right? When 2018 and 2021 all-time highs happened, the markets were going haywire. People were selling, buying, and volatility was just through the roof. But this time, it's much more stable, much more calm. We're not seeing as much reaction to Bitcoin reaching an all-time high, and that's mainly due to the institutional adoption and the ETF inflows. Next up, we have Ethereum, which hasn't fared so well this year. It's had a tough year, to say the least, and mainly it's lost ground as investors have kind of shifted to faster, lower cost alternatives, namely Solana. And while the price of Ethereum has struggled, the network remains strong and the activity remains high, especially in decentralized finance, which crypto dominates. Staking as well is one of their core components. And also an interesting turnaround that might happen for Ethereum this year is that they're seeking approval, or rather, Grayscale is seeking approval from the SEC to enable staking for ETF holders, which would be really unprecedented for cryptocurrencies overall, right? If you hold an Ethereum crypto, Ethereum ETF, you will be able to benefit from the staking that the network offers. And then the third cryptocurrency we have is Ripple, or XRP. Current year-to-date performance is 4%, which is kind of in the halfway point, right? It's proven to be a more stable cryptocurrency than the other two. And overall, I would say. It's had modest gains this year. It's shown steady growth, nothing spectacular, but steady growth. And this was mainly driven by the progress it's had in cross-border payments. It started offering its services in Asia as well as the MENA region. And it's also gained kind of more recognition and has a clear regulatory framework, which has, caused it to be more stable in comparison with Bitcoin and Ethereum. Our next section is commodities. I'll hand it over to you, Akshay. But an interesting segue, I would say, is that, and I learned this while I was doing my research, is that Bitcoin actually makes up 10% of the all gold positions, or all gold holdings, which is an interesting fact in that it's showing that it's investors are matured and now seeing crypto as a long-term asset and then a hedging asset as well. So I thought it was an interesting tidbit that 10% crypto's AUM is 10% of all gold holdings globally.
Very interesting. But yeah, looking at some of these key commodities and what they've been doing in 2025 and why. You mentioned gold, Faisal. Who would have thought that gold, if we were having this conversation last year, stable, inflation adjusted gold would be up 26.6%. The last night Bitcoin was up 14% or something. Who would have thought gold would be outperforming Bitcoin at this point this year? And look, it's had a strong run. Prices hit all-time highs earlier this year. Gold went above $3,500 an ounce. And I think a big part of this, we've just mentioned, right? A lot of things have been going on this year. We have gone from a high to a low, market fluctuation, volatility, a lot of geopolitical tensions. So investors are looking for safety. With everything going on, trade disputes, inflation concerns, obviously now with the conflict going on in our region, gold has become a go-to place to park money. And it's had that sort of, that multiplier effect where a lot of people have been parking funds in gold. It's caused the price of it to rise. So it's doing fantastic so far this year. Silver followed a similar path. It's up 22.73% year to date. It's also seen as a safe haven, but it's also had a big boost from industrial demand, right? And it was interesting to hear that silver has a huge, this huge silver components as a part of solar panels, obviously electronics. So it's not just an investment play, but it's also a material story. So there's a lot more use, and that's been quite prominent this year so far. Moving on to platinum. Platinum has had a stellar, year so far. It's up 43.91%. It's outperformed gold and silver so far. I think some supply issues, especially out of South Africa, have played a very big role. But then demand is also rising. And this is particularly from China's jewelry market and also for use in clean energy tech. So multi-purpose use for platinum. Obviously, there's been some demand issues. Some supply issues, and demand has been rising. So this has led to this huge boost in sort of the performance year to date. And I'd say the odd one out of the pack with our commodities, the one that is not doing as well so far this year and makes a lot of sense. You're looking at crude oil. It's down 8.91% year to date. And oil's been all over the place, right, guys? Like we have seen oil go up and down constantly this year. And I think we're much more aware of it being in the region that we're in. Recent headlines in the Middle East, prices are still down 19%, or sorry, about 9% over the past year. There's been slower global growth expectations. Steady supply has kept a lid on prices. But that said, right, it doesn't mean that it hasn't been volatile. We obviously just mentioned that it has. But the bigger picture has been a bit of a weak demand. It's going to be interesting to see what obviously happens over the next couple of weeks. Eamon, you mentioned, there might be a blockage, of the Strait of Hormuz, but I think we're going to touch upon that in a bit, but let's see what happens. But that's kind of what's been going on with the key commodities so far this year.
Oh, amazing. Thanks for that, Akshay. A few more, data points that we want to share. We're going to talk about currencies. We're going to talk about the UAE real estate market. But I just wanted to pause for a second just to let everyone know you don't have to wait until the end of the session to ask any questions. Feel free to go ahead and pose your question. I already see a few people have jumped in and asked some questions. So I do encourage you. You don't have to hold on to the idea until a later stage. And also, just as a second reminder, so look, our views today should not be interpreted as one-on-one financial advice. What we're doing right now is essentially giving an overview of how the markets have performed over, obviously, the last 6 months or year to date, which by no means is an indicator of how the markets are going to perform for the next 6 months. Just a highlight snapshot, essentially, of how the markets have performed the last 6 months. But with regards to your own personal goals and your personal financial plan, I definitely encourage you to have a conversation with someone on a one-to-one basis so they can have context, understand your goals, and essentially draw out a roadmap for you to achieve your financial goals. So that saying that, I encourage you to ask any questions and wanted to talk very quickly because I really love the quick Q&A period. So I'm just gonna go a little bit quicker on this stage here. Currencies, it's no surprise. It's been topic of conversation for most of the year that whether it be fear about the dollar no longer being the reserve currency to potentially questioning the strength of the US dollar in the near term, maybe a slight depreciation. And I understand. We have seen year to date the US dollar, the greenback, has depreciated relative to other currencies, and other currencies have benefited from the weakness in the US currency itself. So, to more specific, we've seen the euro has had a stellar year. Up nearly just over 12%, benefiting from the dollar weakness and the ECB policies, stinginess, I would say. We had the sterling. We haven't seen sterling behave in this way for quite some time. I remember a point in time where it was much stronger in Canada. I believe it was like 2 point something dollars for every Canadian, sorry, for every sterling. So it was quite strong at the time. Not so much nowadays, but it's gone up just over 8% year to date. The Japanese yen, fortunately, has depreciated relative to the US dollar. Um, and that's a kind of putting them in a difficult situation. And you wouldn't think so at the beginning of the year because the U.S. currency did start out quite strong, but amid these trade tensions, we unfortunately saw it weaken throughout the year itself. And as I said, the other currencies have benefited. I want to now talk about things a little bit more remote here, more specific to what we feel here, whether it be every quarter or every 6 months. And I'm talking about for those who rent or for those who are looking to buy a property within the UAE. It is no surprise that the real estate market has been on fire for the last few years. And you would think there'd be signs of slowing down, but you won't see it by looking at the numbers. Directly from Dubai Land Department, Q1 recorded transactions were 45,474 transactions or properties that were handed over to a new seller or to a new buyer, sorry, in Q1 alone. And if you're looking at it on a volume basis, sorry, on a, yeah, representing a, so this equates to this 45,474 transactions equates to 143 billion dirhams, which is essentially a 22% increase in volume of transactions and a 30% increase in value year over year. So that's quite a big jump overall. So people are buying, people are continuing to move into the region, and they are, continuing to drive rental prices up. And it's not just a Dubai thing. Abu Dhabi is also experiencing some of this growth as well too, where their transactions were up 9% in volume year on year. But as far as the value itself, it's gone up by 75%, which is most of it was actually attributed to off-plan sales. So if you've been paying attention to some of the adverts and some of the I would say billboards that you see, Abu Dhabi has been quite aggressive in off-plan projects. And yeah, that's definitely is showing in the numbers themselves. The average price per square foot has gone up. On Dubai alone, you're looking at about 1,535 dirhams per square foot. Villas are still the hot ticket or hot, items within the region and predominantly within Palm Jumeirah, Dubai Hills, JVC, Saadiyat, Yas Island. These are where areas that have experienced the most notable price increases, when that also includes on rent as well too. What does the near future hold? Well, if according to Fitch, if you've been reading their concern or their reviews of what the UAE market should expect, they actually expect to be a number of units coming onto the market between 2025 and 2028, to the tune of 300,000 units being delivered by 2028. And in their opinion, they do believe that supply will keep up with demand, which is actually going to cause a slight retrenchment in the value of rent and then the value of real estate prices to the tune, and by their estimates, a price correction of up to 15%. Now, of course, only time will tell. As I said, history is not a predictor of the future, but we are arguably, Dubai has been on a bull run with the real estate market for the longest period that this region has ever seen it. I think prior, to this would have been 2006 until 2008, 9 period, but now we're talking 2021 till 2025. That's the longest bull run that they've had in the real estate market, and individuals have done very well in some areas, which property prices have gone up by average of 75%. So, wow, good on you for those who did buy. Now, more to the local region here, and I would say not only just from an investment perspective, but obviously from a geopolitical perspective. Anybody who's been paying attention to the news and obviously every conversation, and for those who are expats who may have contacted your embassies as well too. Obviously, there's a lot of geopolitical tensions here, and although we're going to discuss markets, I think it's also important to recognize the human cost of conflict, whether it be lives lost or families displaced or communities disrupted. These tragedies do remind us that markets don't operate in a vacuum. While the human toll remains paramount, part of our responsibility is to understand how such events can impact economies and financial markets, and which often react quickly to rising global risks. So this is why we want to have a conversation with you about what the potential impact could be on your portfolio, whether it be in the near term or in the long term, and what strategies that you can take. So what we do know, obviously, is that the has been, I would say, let's call it what it is. There's a regional war here with the U.S. conducting airstrikes on Iranian nuclear facilities. In response, there is a threat to the closure of the Strait of Hormuz by Iran. And there's also been retaliatory strikes on our neighbors in Qatar, in the Al Udeid U.S. base in Qatar. Scary things to kind of experience when you're living in the region. Actually, you were on the airplane on the way over here just a few days ago, and you learned this while on the plane. So interesting environment. But I want to hand it over to you. Maybe just tell us a little more
Yeah.
potential impact could be here from a market's perspective.
Yeah, no, look, I think it's, as you mentioned, I think when we are in the region, that there it does feel a bit more real. So for context, right, I was in London and I was meant to be flying back to Dubai, and our flight got cancelled because British Airways, Singapore Airways, a bunch of Australian flights also all got cancelled to our region, and specifically to Dubai, which is, you always think that it's not close whatsoever, but these airlines decided to cancel their flights. I got rerouted to Abu Dhabi, so it's on an Etihad flight from London to Abu Dhabi. And during the flight, you can see obviously the notifications that the sort of plane news, and there was indications that there was a strike that happened in the U.S. air bases in Qatar. And that's something where you feel it a bit more, but then you look at, like, what does this mean for people's investments? What does this mean for kind of their livelihood over here? And I think at first markets braced for the worst. Um, But it's interesting because Iran's response was seen as quite measured, in comparison to what the expectations were. It didn't directly target oil infrastructure or escalate it a bit further. And I think it kind of helped things settle down faster than expected. This was just a couple of days ago, but things tend to have sort of mellowed out. I mean, we're going to obviously see what happens, right? Right after the strikes that happened, the previous week, oil prices jumped right after, right? Uh, Brent crude rose over 6%, but it didn't last, right? Within a few days, prices dropped back down towards where they started. And I think markets are now pricing in a sort of geopolitical premium, as per se. But so, in other words, what that means is oil's trading at a bit of a higher, than normal price because of the risk. But look, if things escalate further, as you mentioned, Eamon, especially if exports are impacted or disrupted, even partially, right, we could see prices climb quite significantly. Some estimates, right, and you can obviously take this with a grain of salt, but Brent at between 90 and $110 a barrel in some of those scenarios. So I mean, look, so far in terms of oil and the sort of roller coaster that it's been on, markets seem to believe the worst case outcome is still avoidable, but we'll obviously have to see. I think it goes to a bit more of an interesting one with equities and bonds and kind of the market reaction we've seen. We've been having conversations about this, and I think for the three of us, there was expectations that I think, we talked about it, right? I thought the US equity market would probably shudder a bit. I thought it would probably, take a bit of a dive where we'd see some volatility, but US stocks didn't sell off, in the last few days. They actually rose. We're kind of on the brink of an S&P all-time high. S&P was up about 1% in the last couple of days. Dow and Nasdaq were both up about 0.9%. And I think that's because the market views Iran's response, a sort of a sign that things might not spiral out of control. On top of that, right, we go back to the sort of macro elements of things as fresh signals from the Fed that they're open to cutting interest rates as early as July. I think this has helped support stock prices. But then bond prices also, moved. Yields fell, investors sought safety, and that's typically what we see in more uncertain times. Emerging markets, they took a bit of a pullback. Countries like India tend to be a bit more sensitive to oil prices. Higher energy costs could also push inflation up, which could potentially weigh down on growth. But I think we're at an interesting point, right? There's been a lot of things that have been happening, and this is kind of how the equity market has responded to it.
Mhm.
Yeah, thanks for that, Akshay. And I'll just wrap up by giving you a few key takeaways, and then we'll open up for Q&A. So as Eamon and Akshay mentioned, oil prices spiked following the escalations in the region. But as Akshay mentioned, quickly it dropped back to the mid-60s range. As you mentioned, and it's right for you to say that the markets have already priced in this geopolitical instability. And it also works on the flip side, right? So how it essentially was de-escalated, and now there's a temporary or a ceasefire that's holding. So markets, as you said, equities specifically, bounce back because of that, right? So it was flipped on pretty quickly, but it was flipped off pretty quickly as well. So oil has come down, equities have started to go up, but we're not out of the woods yet, right? So there are still risks ahead. If either side, engages or escalates, or if Iran closes the Strait of Hormuz, I've heard the Strait of Hormuz so much in the past week, and I have honestly didn't know it was called Strait of Hormuz until this week. But yeah, if Iran does decide to close the Strait of Hormuz, oil prices could spike again. Some analysts are predicting that it reaches the $100 mark, as you said, Akshay. I've also seen some bullish analysts saying that it could potentially reach the $140 per barrel mark, which would be ridiculous. So the inflationary pressures that would come off of this and the market volatility will happen, and it is real. If these tensions reignite, we will start to see this volatility again. So the markets are highly reactive to these geopolitical headlines, and it's not going to fade away anytime soon. And it all really depends on how the parties involved kind of either de-escalate or re-escalate the situation.
Thank you for that, Faisal. I think it's a good time to maybe start going to the audience and start answering some of their questions. I'll go with the first question, which as soon as we launched the webinar was the first question out the gate. And I'll open it up to all of us to have a discussion on how we could approach this. So it's by Anonymous. Anonymous said, my goals for my investments would be number one, capital security, guarantee in brackets. Number two, regular income stream, whether it be monthly or quarterly. And number three, legacy planning. They didn't have a specific question, but I would glean from that that they want maybe some guidance and some advice. How would you approach this, guys?
Well, I mean, first off the bat, I think those are very good goals. I think a lot of people come into investing without having clearly defined goals. And I think these are three very clear things. Um, Now, maybe I can talk a bit about capital security. Look, I think with anything, right? With investing, preservation, capital protection is obviously a goal for a lot of people. And with capital protection or capital security, it comes in two forms, right? You're looking at, number one, not having investment risk or investment fluctuation. For a lot of people, that comes in the form of cash equivalents, money market solutions, more fixed income solutions. Um, Now, with that will come usually lower levels of growth, right? So usually when you have more capital preservation or capital security, um, that comes with rates of return that are tied to interest rates, that are tied to certificate of deposits, it's tied to treasuries, money markets, and so on and so forth. If you go beyond that and you start to reduce that level of capital preservation, you start to increase your level of risk, which comes in the form of different asset classes like we talked about crypto, we talked about direct equities, we talk about ETFs. These are things that will still provide a level of capital security, but the level of risk is a little bit higher. You'll see more market fluctuation, but in turn you will see more growth. So it just depends, what the level of risk you're comfortable with and what the reward you're looking to seek. But I
Essentially,
think, yeah,
really today, it's a spectrum from, I mean, just to pick a random number, but from 0 to 100. And it's about what's your comfort zone of what does capital security mean for you? For others, it's the, equivalent of leaving money underneath the mattress. And we laugh, but it is a conversation that we have from time to time with clients who say, yeah, I've got a little bit of money stacked under cash in case of emergencies. And for some, it might be leaving money in a bank account. For some, it might be in a money market solution. And it just goes on. It's just an escalation of the spectrum of different levels of risk and what level of risk you're willing to tolerate, for the returns that you can potentially receive. So, I mean, on this point, I mean, we've got a number of different solutions here at Sarwa. There's no question. We've got solutions which are made for individuals on one end of the spectrum and solutions for an individual on the other end of the spectrum. So I definitely would invite you to have a conversation with us, Anonymous. I know you haven't shared your details, but happy to share our access to our diary, towards the end of this webinar. So feel free to click on it. It'll take you right into our diaries, and you can book an appointment for a video or a phone call. We can take it from there. The second point about regular incomes, whether it be income stream, whether it be monthly or quarterly. So interestingly enough, I mean, again, it comes down to choices as well, right? So if you're looking, and I guess it's dependent on your personal circumstances. Are you at that stage of your financial journey that you require income? Um, and I don't mean there's so many different ways I can essentially address this. And maybe I'll give a persona. So suppose you were 25 years old. You're at the beginning of your financial journey. That journey essentially should really be more focused on capital appreciation because if your focus is on dividend generation or income generation, that comes with an opportunity cost. And that opportunity cost essentially is the capital appreciation. It's very rare, I would say, don't want to say impossible because nothing's ever impossible. It's very rare that you're going to have a solution that is going to give you great capital appreciation and also great income generation. More often than not, it's a trade-off. I want capital appreciation, so I'm going to have to sacrifice or compromise my income generation of it, or it's the other way. But if you are, let's just say, at a latter stage of your financial journey, maybe you're no longer working, or maybe you don't have any primary sources of income, and that means that your investment portfolio is the key, I would say, source of your day-to-day income to be able to pay for the expenses, to enjoy a great quality of life, then that means naturally your portfolio may lean in the direction of more income generation and preservation versus opportunities for capital appreciation. those solutions do also exist. And again, to that, I would say have a talk conversation with us because this is something that's very curated, very specific, and we also need to learn a little bit more about your present circumstances. On the point of legacy planning, I don't know, Faisal, do you want to maybe touch on this, or I can jump on this, or anybody, any insight that you want to maybe share with our anonymous here?
Yeah, I wanted to add, and I like how you put this question and juxtapose it next to where they are in their financial journey, right? Because immediately when I hear or read a question like this, the first thing I think is where are you on that timeline, right? Are you early? Are you in the middle? Are you, closer to the end? And also tied with your risk appetite, that you mentioned that it's highly unlikely that you'll find something that will appreciate in value, but also pay you income. And the first thing that came to mind is some people, although it might seem extreme, but for capital security for them is investing in Bitcoin, and then regular income is staking that Bitcoin, right? It sounds extremely risky, but for them, that's how they want to protect their capital, and that's how the risk appetite is set up. But I would say for legacy planning, again, as anyone mentioned, we need to know more information about you, your goals, where you are on your timeline. But I would say we have simple tools available on our website that you can utilize just to kind of get a head start or just kind of get an idea. It's called a retirement calculator, and it's a very simple but very effective tool that kind of helps you kind of come to a calculation or project your financial plan right in front of you, just a few clicks. So I'd recommend you check that out as a starting point, but we can also offer some solutions to address that need as well, etc.
And look, if any case, in the case that when you mention legacy planning, because legacy planning could be interpreted in many different ways, and this is why it's really important to have a conversation. It could be more about long-term planning. What do I do in order to ensure that I have a particular nest egg? But it also could be that you're talking about, well, what happens to my assets, in the event that I'm no longer here? Really uncomfortable conversation, but a very important one that as advisors we have with our clients quite often. And in this case, I'll share with you that within Sarwa itself, you have a tool within all of the products that we offer, whether you're more of a self-directed investor or whether you're a client who likes to have their portfolio managed or whether you'd like to park your cash in a high yielding account, you are able to nominate a beneficiary. And what that essentially means, Mr. or Miss Anonymous, is that this is your legal, this is a legally enforceable document that essentially follows your wishes. It's you communicating to us, your advisory firm, that in the event of something should happen to you, I would like you to disseminate the assets in the following form, whether it be an individual or a number of individuals, and you could decide upon what percentage you'd like to allocate. Now, saying that, this is a very simple and very specific approach to your relationship with Sarwa, but as I would imagine, your financial picture is probably a lot more complex than just Sarwa in this case. And this is where experts can actually really assist you. And we have a network of solicitors who specialize in this area, who we've done webinars with. We've invited them to a number of events that we've hosted with our clients to get to know our clients because this is beyond our expertise. And you don't necessarily want us to give you advice on how to do legacy planning. You want an expert who focuses on this day in and day out, who has experience in this field. So we're happy to introduce you to a few stakeholders that we know who specialize in this field. But I do encourage you to look at our webinar that we hosted on inheritance planning within the UAE. It's on our YouTube channel, so you'll be able to find it.
And I also just saw that Anonymous actually said that they do have a call with me booked for next week. So excited to
Oh,
have that call with you. And we can address all of these things and more during that call next week. So excited to speak to you next week, Mr. or Mrs. Anonymous. So we've
exactly.
actually got a couple of questions about goals. So we've got one from Ahmed. Ahmed, thank you for your question. He said near-term and long-term goal prospects. And then we've also got Tim asking, how do you feel about gold long-term? It seems to have reached a peak around the same time as the global geopolitical situation is most volatile. Is this indicative of a limit in its sentiment as a safe haven? These are great questions, and gold has been such a hot topic, so far this year. Look, I'm going to put my sort of 2 cents on it, maybe in terms of near-term prospects, and then guys, please jump in as well, for any input that you have. But when we're looking at gold in the near term prospect, right? Like assuming the next 3 months to 6 months, what's been happening at the moment, right? There's three key components that have been, sort of overarching. One is interest rate, central bank policy. The other is obviously geopolitical tension. And the third thing is inflation. So depending on how each of these things, move in which direction they move in, they can tend to potentially impact gold, right? So gold tends to move inversely with interest rates, right? And interest rates have been such a hot topic recently. So if the US Federal Reserve signals rate cuts, look, there's been obviously a lot of hypothesis that this is potentially happening. Gold may benefit from lower yields and a weaker dollar, right? So that's something that potentially might happen. Um, right? There's expectations that there might be potential rate cuts by year end, and that could potentially support gold prices, but no guarantees on that, right? With any of these things. Now, an interesting one, geopolitical tensions, right? Ongoing instability in the region, political uncertainty that's heading towards the US. Um, People potentially might still see gold as a safe haven. That might, elevate the demand as well, which could, in turn rise prices. And then the last thing, inflation, right? Inflation, if it remains sticky or resurges, gold may continue to act as a hedge, especially if real yields decline. But once again, right, we'll really have to see exactly what happens. And I'd say, the near-term bias is relatively positive, but there's no way to really determine exactly what's going to happen, because these are so many different things, right? Some that it's political, it's social, it's economic, and all of these things would need to marry together to kind of impact it. So that's kind of where I think what a lot of economists and analysts are saying for near-term things. Guys, I don't know if you have any insights on
I
that or
mean,
maybe some insights on long-term stuff.
like I would say in my experience, people talk about gold when it's on a run, but when the markets are stable, everybody
Yeah,
forgets about gold. And the
that's true.
individuals who buy gold are the ones who buy it because it's part of their diversification strategy. Or there might be sentimental reasons, or I'll say cultural reasons as to why they may consistently buy gold or have an allocation to gold. But you notice that over the years, that the only time it comes up as a topic of conversation is when there's a run up, and that run up is as a result of volatility and panic in the market. So despite, the many decades and years that we've been operating in the investment space, and when I say we, I mean globally, the world has been operating in investment space. Gold still is perceived to be a safe haven. It is very much a sentimental decision that drives the price of gold up or down. And there are no other drivers, I would say, and I hope nobody crucifies me here for saying this, but I would say from practical experience over, 20 years of working, there are no other practical drivers beyond fear and panic that essentially drive the prices up. And I'll kind of, and I mean significantly drive the prices up. I think most people are not really necessarily interested in an asset class that's going to give them the potential 2%, 3% appreciation year on year. It's not topic of conversation. But I want to kind of do just a quick thought exercise, right? So I'm just going to pick a company random. It's not an inducement, it's not recommending it, but let's pick Microsoft, right? You have so many data points to decide on whether you want to invest in Microsoft or not. And each and every one of those data points are being analyzed, scrutinized by every investor to decide whether they're going to buy or sell that stock. There might be, the CEO made a bad decision, or the board is, going in the wrong direction. Oh, the product is not doing so well. The market share is diminishing. Maybe they're not priced correctly. Any number of different variables that you can talk about when you talk about Microsoft. In fact, you can actually look at their financial statements and you can really understand all aspects of the company. Gold, much like certain, cryptocurrencies, I'm looking at you, Faisal, since I know you were talking about that earlier on. It's based on what? You want to say demand and supply, but there's always more gold. There's no shortage of gold deposits. We tend to find gold deposits constantly, but it's more or less the sentiment that drives the buying of the gold and essentially drives the selling of the gold when people find another asset that is going to be much more lucrative for them. As financial advisors, I would say, and I think this is a consensus, I would say, across all the different geographic regions in which financial advising is provided, is that it is recognized as a great asset class, but it's also recognized as an asset class that you should not have an exposure to beyond the 5 to 10% allocation. Why is that? Well, the fact that it's recognized as a legitimate asset class is because of its performance. It has done well. It's a great diversifier. And for all the reasons that Akshay has mentioned, as far as, when market goes this way, sometimes it has ability to go this way, et cetera. Interest rates go that way, et cetera. But the challenge is that gold doesn't reward you for holding on to it. Unlike Microsoft, unlike, ABC company, you receive dividends, you receive income as a reward for holding on to the stock. Gold, you can only materialize the benefit by selling it, by selling the asset. So as a result, it's considered to be an inefficient asset class. So great as a diversifier, 5 to 10%, but beyond that, you start getting into the zone of inefficiencies and opportunity costs at that point in time. And as I this is kind of my 2 cents on that one.
Amen. Thank you for mentioning Bitcoin because we often hear Bitcoin as being the digital gold, right? And it has a reason why people call it a digital gold. And more it's being seen as a parallel or kind of a complementary hedge to holding gold. And although correlation to equities or traditional markets has started to become more positive, but nonetheless, at least maybe with the younger generation, they see gold, or sorry, they see Bitcoin as, I would say, gold 2.0, right? Because it kind of has the best of both worlds. It has kind of the hedging element of gold, but it's not as inefficient, right? You can stake your Bitcoin, Bitcoin can work for you. You can get some sort of return from your Bitcoin. So it's an interesting kind of subset of the market where it more or less people are seeing it as a hedge, but also it has way more growth opportunity than gold itself.
Amazing. Thank you for that, Faisal. I am conscious of the time, but if you guys are okay with it, I'm okay to stay over. And for those who are not able to stay, completely understand it. This is a recorded session, so you will have this emailed into your inbox, so you'll be able to review it. But do stick around if you have any questions, right? I want to kind of maybe, I think we've touched on the gold, and I think we've done justice to answering it from many different angles because there's a number of questions about gold, but I think we've kind of covered it quite well. I want to maybe touch on another question, which is about the US stock market. So hold on. George Ninan, lovely to have you with us, George. George said the performance in the S&P 500 have been mainly attributed to the Mag 7. So would it make sense to invest in these 7 stocks instead of the entire index? Good question, George. How do you guys want to tackle this one? So essentially, George is saying, should I just forget about the other 493 stocks and just focus on these 7, or should or yeah, or do you have any difference of opinion on that?
This is such a good question
Yeah.
because more more recently, I actually wrote something about this on LinkedIn, like a couple of weeks ago. Over the years, if you look at the overall S&P 500, the concentration of the top performers has been just increasing and increasing and increasing over time, where now just a few stocks represent, right, the overall pretty much the overall index. And now the question is, do you follow the index or do you choose to be a bit more selective, especially, given the S&P 500's concentrated leadership with these, top 7, the Mag 7, they drive a disproportionate share of the index's return. So, what's the benefit of investing in the Mag 7? They have dominated the market share. They've shown resilience. They have driven performance. But I think with that, it's always important to be a little bit cautious, right? Because, this dominance creates crowding risk. Any collective pullback can drag the broader the broader index down. Um, and tech is cyclical, right? We saw it earlier this year where, the tech market took a huge pullback. And, even though these are 7 different companies, they tend to follow, a relatively similar direction at certain times. So the purpose of having the S&P 500, the purpose of having, you know, thousands of different companies is for that diversification. So I would say there are definitely interesting names and opportunities outside of the Magnificent Seven. Um, there's a lot of different, underlying companies and even companies beyond just the S&P 500 that it's worth looking at investing. I think it's going to depend, George, on obviously your investment goals, your understanding of the market also to determine exactly if those companies might make sense for you.
Mhm.
Yeah, I would say ultimately it boils down to your risk appetite, right? Because if you choose to focus on the top seven, then there's a concentration risk. As you said, Akshay, if they take a tumble there, then you'll feel it, you'll feel the brunt of it. And whenever I'm faced with this question or dilemma, I immediately revert back to Warren Buffett and how he said, instead of trying to find the needle in the haystack or trying to, focus on one particular stock or set of stocks, just buy the whole haystack, right? And that's kind of what he means. And diversifying to the SP 500, although the risk would be spread out, but they have S&P 500 has shown very healthy and consistent returns over the years. So it's not like you're foregoing amazing returns for really bad returns. They're still pretty good returns.
Mhm. No, I'd agree with that, and just kind of expand on that a little bit more as well, George. Is that so? There was a webinar that we had done a little while back. Actually, it was an in-person seminar. My apologies, an in-person seminar where we came across a study that was done by a university, and I'm happy to share it with you, George. I just need to find that deck again. But essentially, there was a study that was done by a university who reviewed the U.S. stock market in its totality for the past 96 years, ending in 2006, I believe. I can double check, but it was in the 2000s essentially. So they went back 96 years. And what they found was that the median lifespan of a company being listed on the US exchange is 7.5 years. Why I mention this is that the Googles or the Mag 7s, I'm just going to consolidate, the Mag 7s of today will not necessarily are unlikely to be the same Mag 7s 10 years from now or 20 years from now. And that's a reality that we've seen over and over again. There is a rotation on an ongoing basis in the US stock market regardless of how strong you think a company is, the odds are against them that they will likely not be dominant for an extended period of time. There are peaks and troughs within that financial life cycle of every company. I'm a bit older than you guys, so I remember a day that they were talking about General Electric as being the top company. They were in everything. GlaxoSmithKline, they were, the most talked about, pharmaceutical company or yeah, pharmaceutical company. There was companies like IBM who were on par. People were talking about when it comes to Google and Microsoft, etc. Things change. And for you to be abreast of all the changes in time, and in time meaning that you have a crystal ball essentially to predict which direction that the company is going to go is very challenging, and statistically the odds are against you. So average or median timeline is 7.5 years. But interestingly enough, to your point though, the top seven companies, the same study also identified that the when people look at the S&P 500, for example, and they say, oh, it's generated a 10% return, since inception, they're correct. And you would also be correct in assuming that a handful of companies are actually driving the majority of those returns. That is correct. The same study also identified that only 4% of the companies that were ever listed on the US exchange were responsible for the lion's share of the returns in the US market. The problem is you just don't know who that 4% is. Things change, circumstances change. And unless you're going to take a very self-directed approach and you're going to be a very active investor and have a strategy of which you are diversified, maybe amongst the seven, maybe a little bit beyond that, it could be quite challenging to be a part of that 4%. So to that, I say, going on to what Akshay and Faisal was saying, that diversification is key. Diversification entails that you acknowledge that the markets are unpredictable, they can change, that companies can come and go, variables can change, circumstances can change, markets can change. And I don't just mean stock markets, but just the ecosystem that these companies operate in. Things can change. And when you diversify, it's a very effective approach, whether it be by way of ETF or you do it on an individual basis. It's a very effective approach to grow your wealth in a sustainable way. No guessing required.
I also just want to quickly add to that, George. We do send out a weekly and also sometimes a daily newsletter that has a lot of research and insights. So sometimes we actually highlight, individual companies and different indexes in different markets. So if you are, you obviously asked the question about the 493 other ones and beyond. I'd recommend taking a look at that so it can provide some research and inspiration for you to maybe then make a decision if you do want to obviously go beyond just those 7 companies.
Brilliant, brilliant. And we've had some really great webinars recently actually on these topics. You're absolutely right. There's a great question by JP. It's more about product specific. JP is asking, can we invest into mutual funds or US mutual funds in addition to ETFs via our Sarwa trade platform? Anybody want to jump on that one? My mouth is getting dry from talking, so I'm just gonna have a glass of water.
Yeah, quick answer to this is that any stock or ETF listed in the US stock exchange will be available on Sarwa Trade, in addition to some lovely cryptocurrencies. You can also find commodities, REITs, but the underlying requirement is that it's an asset listed in the US stock exchange. It will be available on Sarwa Trade.
Thank you, Faisal. There is a question here. How much, by anonymous as well, how much should I anticipate each month or year since I recently opened a Sarwa Invest account with a risk profile 2 out of 6? What must I do in order to generate a healthy profit in capital appreciation? Um, can we put our returns on our on the Zoom link? Can we share screen? Faisal, if you've got access, can we? So by the way, anonymous. For our Sarwa Invest portfolios, these aren't proprietary portfolios. Our strategy is proprietary, but the portfolio themselves are publicly available ETFs. And what we do is we publish the historical returns right on our website. Now, you've mentioned that you're in a risk profile 2 out of 6, but we don't know from what you've said whether you're in a conventional portfolio, whether you're in a halal portfolio, a socially responsible investing portfolio. So we don't have enough to be able to tell you, well, this is what the historical returns are, but we'll show you where you can get them. At the top of our homepage, you go to Manage Investing. You're going to see a very familiar individual. I swear to you, there's more than me that works here. There are other people that work here.
Oh, here you are. So yeah,
You're going to
so you
scroll
basically,
down. So here you click on historical performance, and depending on your portfolio type, and you mentioned you're in a risk profile 2 out of 6. So I'm just going to assume you're conventional for the purpose of this exercise, which means that you're in a conservative portfolio, which means that majority of your portfolio is essentially is predominantly fixed income. Well, in this case, actually, it's 50-50. My apologies. 50-50 split between fixed income and equities. The historical return for this portfolio has been 6.9% net on average year after year since inception. And this is on a conservative portfolio. But yeah, I encourage you to go to our website and to everyone here who's in our audience. So this is our Sarwa Invest service. This is where we curate a diversified portfolio of ETFs for you. They are globally diversified. We do believe that this to be a very sound strategy to help you benefit from I would say risk mitigation perspective. Actually, earlier was talking about developed markets. Oh, developed markets have definitely propped up our portfolios this year because you have an allocation to developed markets.
And if one more point also, actually, if you can go back to sharing that screen, another tool I think that would help you is the retirement calculator. If you wanted to kind of assess or test out different kind of simulations and test out different levels of monthly contributions, the retirement calculator is a really good tool. It's very simple yet very effective in helping you kind of find what is the best sweet spot for you in terms of how long you want to invest, how much you want to invest.
Brilliant.
and you'll also see me down here.
Now I feel left out.
You're somewhere. I saw you on the website.
I think you're on the homepage, Faisal, but
Just
yep, there
There
you
you
are.
are. Okay, so
So if
I
anyone in
get
the audience
the
wants to
IV
find
treatment.
pictures of us, this is how you find it.
How did you get the front page? We've got other questions here. Sarwa Save Plus. Again, this is anonymous. Is it also a guaranteed interest rate, same like Sarwa Save?
Okay, so this is a good question. So, Sarwa Save Plus is not a guaranteed interest rate. So to understand it a little bit more, Sarwa Save Plus, the underlying asset is a money market fund. Now, a money market fund is a short-term duration uh, fund that operates in the money market. So things like cash equivalents, usually they have a duration of less than 1 year, and they're usually the duration of the instruments are around 90 days. Now, what that means is it's very well tied to central bank policy and federal fund rate. So usually the central bank rates in the United States and what's happening with their or their uh, federal interest rates. So it's very tied to that. It's not guaranteed as per se. That there is obviously chance for it to fluctuate, but it doesn't fluctuate on like a daily basis or anything like that, like a stock does. So usually, central banks, if they increase or if they cut rates, it tends to happen on, let's say usually like a quarterly basis. If it does happen, you're seeing, ranges of 0.5% usually, but most likely it can be 0.25%. So it might change very slightly. But very similarly, that's what cash deposits also experience a similar thing as well.
Brilliant, brilliant. No, spot on.
There's a question from Ahmed. I really like this question, and it immediately takes me to Andrew Hallam. And Ahmed's question is, as U.S. market is already near highest point, what can be near-term and long-term prospects? And it goes back, so we had a wealth summit earlier in this year, and Andrew Hallam shared a really nice kind of illustration of his journey with investing. And basically, he pointed out that within the last, I forget what the time frame was, it was 30 or 35 years, within that period, do you remember, well, how many times the US market reached all-time highs?
The number, but it's a running constant, really.
Mm.
The market is created to reach all-time highs. It systemically will reach all-time highs over time. But sorry, I cut you off, Faisal. Go
No,
ahead.
no, exactly. Well said. That's exactly how he put it as well. And just because a market is at or nearing its all-time high doesn't discount it, doesn't necessarily deem it to be, okay, I'll just wait, sit it out and wait until it goes down for me to go back in. So having that mentality will often hurt you rather than help you when it comes to entering the market.
I should caveat what I said that the systematically they're created to go up. I'd say if things are functioning
Yeah.
properly, that's the key word, because there's definitely other markets who have not consistently gone up. Japan, case in point, is a perfect example of this, where they had systemic issues that unfortunately caused them to be in the position that they're in today. But in the case of the US market, and I would say all as extension global markets, if you look last 10 years, 20 years, Ahmed, 30 years, 50 years, go back nearly 100 years for as long as the stock market has been operating, there's always reaching new highs. And kind of some of the levers that cause markets to continuously rise, um, you can't discount human ingenuity. The technology that we have today is much more comprehensive and significant than it was 10 years ago or 20 years ago and 50 years ago. And technology doesn't just mean what we see on our screens and gadgets in our hands, but it also comes to industrial applications, chemical applications, any number of different industries altogether benefiting from technology improvements, which by way have helped companies derive better margins, who have then posted better profits. And that has essentially channeled its way in many different, ways back into the stock market itself. So that's human ingenuity, essentially being the driving force for innovation and growing the markets itself. Secondly, I would say population, Ahmed. The population still continues to rise. And I know in certain markets or certain pockets around the world, there's a concern about, depopulation, but by and large, the population is rising. And in addition to the population increasing, you also have markets that were traditionally struggling markets are now markets who have strong economies. There's an emerging, I would say, middle class that is able to spend. There's consumption that essentially also channels its way into corporations as well too. I mean, this is just two of the many different reasons as to why the stock markets in general tend to trend upwards over the long term. So what it is today, if it's an all-time high today, you're going to be seeing this a lot over the future as well. So it's not something that you're just going to see once and for all. I think it's time maybe one question, guys. Now we're kind of pushing it here. I know you guys have to go eat dinner and I think I'm spent. It's been a long day. So let's take one more question. to be able to assist an individual here today. And just as a reminder, everyone, this is recorded. You will have this emailed over to you. What I want to do, guys, and I'm just trying to figure out how to do this, is I want to put our Calendly link on here for everyone, but I don't know how. I don't know
I
if I
can
put it
do
in the
that.
chat. Would you mind? We have
Yeah,
the
sure.
yeah. I want to
Yeah,
make
I think
calendars.
that's a great idea because any questions we didn't get to, I think it'll be a great opportunity for you to just book in a call with us directly. We can have a one-on-one conversation. You can ask us these questions and many more. So please go
Absolutely.
ahead and do that.
Bring your coffee, bring your tea. Let's have a chat, guys. But promise you we don't bite. Who should we pick as our last question, guys?
Oof. Let's take a look.
I'd say there's one here, if I may, and it says, "What are common issues and problems when deciding to invest in ETFs?" I think that's a really great one,
Oof.
and that's
Very good
that's
question. And I
yeah,
feel like this is a question that sparks debate and discussion at the same time, right? Because I think a lot of people, and I guess I'll go on the more contrarian and be a bit more devil's advocate. I think by default, if you ask anybody nowadays, what you should invest in, a lot of people will say index funds, they'll say ETFs. They're incredible, they're very low cost, they are very well diversified, they've performed very well over time. You know, but when you look at the sort of return for ETF investing, or specifically, these well diversified funds, they perform well, but they don't perform anywhere near as well as these concentrated positions. Whether that's in individual stocks, whether it's in, cryptocurrencies, whether it is in, a variety of different other avenues. So I would say that's potentially not necessarily a problem as per se, but that is, potentially, a concern. The high level of diversification has meant that, the concentration of performance is not necessarily as high in certain circumstances, right? Maybe in the short term.
Mm, mm, mm.
I would say I personally love ETFs, right? It just makes things easy, very cost effective, and also, as you said, actually, usually someone either has a stance on the far right or far left, but you can have both, right? You can apply a core and
Yeah.
satellite methodology, and you can have a huge portion or whatever portion within ETFs, and then you can have a concentrated portfolio where you're focusing on that specific stock or that specific segment in the market, and that's a popular style, and I apply it myself as well, right? I have my passive long-term portfolio that's held up with ETFs, but I do like to focus on a specific subset of the market where I can take a more active approach. So I would say a combination of the two is good. You don't have to be on either side of the argument.
I love it.
100%.
Forcing us to think of it in in a contrarian view, as you said, actually, which is really unique way to address it because some would say we are the ETF people here at
Yeah.
Sarwa for the longest period of time. And it's hard for me to argue against it, but I will say that an ETF by design tracks the index. Which essentially, at times we kind of have a very strong feeling that the market's going in a very particular direction, and that means that it doesn't have any active strategies to mitigate against any tailwinds that you can really see ahead of you. I mean, to give you an example, you're driving on the road and a tree falls right in front of you. An example, if this was an ETF, this car is going to keep on going. It's going to hit the tree and it's going to rebuild itself, fix itself up, and it's going to keep on going. Whereas if it was maybe an active solution, such as maybe a mutual fund, or maybe if you were the one who was behind the driver's wheel and picking and choosing your own stocks, you may be able to see this tree falling and say, you know what, I'm going to divert and go in different directions. Now, saying that, you would think, well, that's common sense. Why would anybody want to be in a vehicle that's going to hit a tree that's going to crash? And why not kind of be behind the driver's wheel and decide which direction I'm going to buy this, whichever direction the market is going, I'm going to buy accordingly or take defensive positions or more, offensive positions or maybe hire an actively, hire a manager to actively manage my portfolio. The numbers don't show that this is actually the better outcome. This is the reality of it. Because of the fact that we are human and we are, to be human is to err, and we are subject to making mistakes. And every active portfolio manager has been basically benchmarked against indices, and consistently, time and time again, it has shown that just tracking the market does better for the individual over the long term. At
Yeah.
the end of the day, if you're taking the wheels, that means that every decision, nearly every decision, needs to be right, or at least more right than wrong. And if you're hiring an active manager to manage your portfolio by view of a mutual fund, they also need to be right more than wrong. And history has shown that not to be the case. So, to your point, yes, these are the issues, but even in spite of the issues, it's still a better performing asset altogether over the long term than most asset classes.
Yeah, and once again, right, risk reward, and I think also it's important to know that different asset classes play a role, depending on what your circumstances are. Um, so I think, I would encourage you to book in a call so we can have a more in-depth discussion about what your circumstances are and whether ETFs make sense for them, right?
The link is in the chat, so for you to book a call, please do so. And also, if you have any other questions, whether it's Sarwa related or anything, you can also reach out to our customer support on WhatsApp. They'll be happy to take your questions and even direct them to us if need be.
Thank you very much to everyone who joined us today. Thank you, Faisal. Thank you, Akshay. Really enjoyed this session with you guys. We should definitely do this again. We don't need to wait 6 months to do this. Maybe we'll do a periodic update. But you know what, guys? We have a number of webinars that we've hosted on a variety of different topics. I've seen some suggestions in the chat about different topics that you want us to cover. Thank you so much for those. That's actually a very interesting idea. Maybe we should explore doing that actually. And I encourage you to go to our YouTube channel, a whole wealth of information, and join us again for any future webinars. Have a wonderful evening.
Thanks, guys. Thank you.
Amazing. Thank you, everyone. Have a good one.
Bye-bye.